Hello guys, welcome back. In this video we are taking a look at another completely decimated retailer, ROST Stores, with a very fitting ticker symbol here which needs just an A over here to make it roast or roasted or something of that sort. But as you'll see, it's actually down 25% after hours, after reporting earnings, which we're going to examine, and we're also going to take a look at what the company is doing financially and see whether it's worthwhile buying them. You will see that if we take a look at the max chart, this is a very old company. It has been doing well with this little slump over here back in 2020, but then again it has dropped at similar levels right now, and it's gonna be down probably about after this slump over here, probably about like 40% or so when it opens up tomorrow, maybe a little bit more. Now, let's take a first look at what happened in terms of the report. The shares of the company tanked 25% on the Q1 results. Let's see what happens here. So, net income came in at 388 million versus the figure 1 year ago, 476. That's a steep decline, as you can see over here. Per share earnings of 97 cents, much worse than 1.34 of previous year. That's indeed a massive decline here as well. Quarterly revenue slipped 5%, and as you'll see here, the consensus was for $1 of EPS on $4.53 billion in revenue. Same-store sales down 7%, operating margin dropped to 10.8%. And the CEO basically said that they are disappointed with our lower than expected Q1 results. Following a stronger than planned start, sales underperformed over the balance, etc. Basically because of higher freight and wage costs. That's a known thing. Of course, we know about this one. For fiscal 2022, they forecast their per share earnings to fall between 4.34 and 4.58, below the analysts' expectations of $5, and that's gonna hurt them, of course, as you can understand. And a day earlier, they have announced a quarterly per share cash dividend of 31 cents. Very interesting. Let's see what is going to happen. It looks like 2022, it's going to be a difficult year to predict, and probably a difficult year for all these retailers. But what we need to examine here is what the company is doing financially and whether this kind of steep decline is going to open up at around $69 to $50 to $70 probably, makes for an interesting buying opportunity. P/E ratio of the company is sitting at 19. It's going down a little bit from its massive levels back in 2021 actually. And price to free cash flow ratio at 27.6. Outstanding shares that are going down a little bit, so the company is buying back shares, some shares, so that's good to see. A little bit extra in terms of total liabilities, it looks like. We're going to examine that. And the revenue growth has been increasing over here, 33%, not massively of course. And net income growth also increasing with a little bit of a slump. 2021 looks like it was a year where the company didn't do that well. And free cash flow growth is actually down. Now total equity is increasing without the company issuing more shares, so that's good. Very interesting price to sales ratio here, very low. So the revenue that the company generates compared to the share price is actually rather low, and this is gonna get lowered tomorrow. So very interesting. Debt to equity ratio a little bit more debt than we would want it to be. But the dividend yield of 1.2% means that we have a payout ratio of 35% here in terms of free cash flow, which is good enough. And of course, great return on equity. Maybe this is why the company has more debt than normal. 9% net income margin. And if we take a look at the dividends, we will see a pattern of dividends getting raised, and some years actually significantly getting raised. I like to see that if I'm actually an income, an income targeting investor really. But the current dividend yield is 1.34, the effective one, and it's going up tomorrow, definitely, because the stock is down. So probably, something like 25% higher tomorrow is going to be this value, which is what, like maybe 1.6 or 6 or something of that sort. Now, let's take a little bit of a look at the income statement. The revenue of the company hasn't been increasing massively. This company is increasing its revenue, but not at a great level. And net income has been increasing again slightly, as you'll see. And 2021 was terrible, but 1.3 to 1.7, okay, in the last 5 years. Very conservative growth. And in terms of total equity, 3 billion to 4 billion, again, conservative growth here for the company. Now that doesn't mean it's not a buy, of course. So the cash provided by operating activities is 1.7 billion here, which incidentally is very, very similar to the net income that the company generated. Very, very interesting for this one. Like, yeah, because they had some change in working capital for the most part and some change in inventories over here. So this is why. Otherwise, it would be higher. But net cash from investing activities minus 500 million almost here because of PPE expenses, which is basically capital expenditures, so normal stuff. And cash from financing activities, paying some dividends, repurchasing some common stock pretty much. And this year they repurchased the most actually, 2021-22, that is fiscal year. And cash at the end of the period about 5 billion, increasing nicely, increasing the cash reserves nicely. I like to see that. 1.31 billion of free cash flow to 1.18, but again this was probably a one-off. There were some inventory changes here and change in working capital. I'm assuming these are one-offs. And yeah, 1.18 is the free cash flow right now. Okay, let's take a look at how much to pay for the stock right now if we wanted to buy it. Alright, so as we noticed, the company's revenue has been increasing in a little bit of a steady manner. So you can see that this was basically caused because of 2021, because the company has been increasing their revenues like 2018 to 2020. There has been an increase, as you can see, but then 22% down in 2021. So this may have been caused by the pandemic, actually, this kind of suppression here, which seems to be getting better in 2022. That is the fiscal year as defined by the company. And it's 18.92 here. Now, we don't necessarily know what the company is going to be doing for the next few years, like the next 5 years. But I'm tempted to go relatively low here. So I'm going to go 5, 7, and 9 for our revenue growth. And the net income margins that the company has been achieving is similar to like 9 and 10%. Again, this one is going to be the odd one out. I'm not going to be paying too much attention. But the other years, it's like 9 and 10% pretty much universally. So I'm going to go 9.5 and 10 over here. And the free cash flow margins, again, they are sitting at a similar level to like 90%, 100%. So I'm going to go to near this one, so 80, 90, and 100, and 13% for the annual return that I want to be making. So if I hit calculate, I'm getting that based on the current price, the stock is a little bit overvalued right now, but not tremendously. It's only the high estimates here that are giving us a value of max price to pay, that is $105, which is higher than our current price, meaning that it is a buy. But if we take a look at the low and medium ones, like the medium ones are not very far from the current price. And remember, the current price is actually 92 over here, but the stock is going to be down 25%. So it's opening up at 60 tomorrow, which means that we are within our limits for our medium estimates here and very, very close to our low price to pay over here. And so I'm beginning to like this company at this current valuation, because I think that it has been completely battered down and there is potentially some future when things go back to normal. And if it keeps on falling a little bit, especially if it goes below 60, that would be an amazing opportunity. And it may actually go below 60 tomorrow. So just grabbing a little bit then, it may not be a bad idea. So there may be some short-term issues with these kinds of companies, like especially retailers, like right now in the short term. And you may be able to get it at a better price even if you wait. So I would probably wait it out a little bit, but if it gets to a lower level, I would be tempted, frankly. It looks pretty neat what is going on with this company, even though it has been having some bad quarters. Every company will be having bad quarters, and especially in this current environment, but we want to be buying it for the long run. And I like the fact that they have been increasing their supplies, their cash reserves, and they don't seem to be having too much trouble with debt. So yeah, I like all that, and I think that maybe at a price of less than 60, which again probably happening tomorrow, I could see myself buying this one. Thank you for watching the video. I hope you enjoyed. Please leave a like and subscribe, and I'll see you in the very next one. Bye bye.